There's this incredibly specific moment in the life cycle of pretty much every e-commerce business.
Oh, absolutely.
Right. Like you've launched your store, you're grinding away, and finally things actually start to click.
The fun part.
Exactly.
Right.
You're shipping orders to 10, maybe 20 different states. You're watching the Shopify dashboard light up and you're, practically popping champagne.
Yeah.
But then suddenly you wake up in a cold sweat at like 3:00 a.m. because
Yeah.
a single terrifying question just popped into your head.
Let me guess. Taxes.
Yep. Wait, where am I supposed to be collecting sales tax for all of this?
It is, it's honestly the ultimate mood killer for a growing business.
Totally.
You go from feeling like this retail genius to feeling like an accidental tax evader basically overnight.
Right.
And, the anxiety is entirely justified because navigating U.S. sales tax across 50 different states is, it's one of the most complex operational hurdles a merchant is ever going to face.
Which is exactly our mission for today's deep dive. We are taking a really comprehensive look at Shopify's U.S. sales tax framework to basically demystify the entire process for you.
Yeah, there's a lot of confusion out there.
So much. And we really want to separate the automated magic that a platform like Shopify provides from the very real, very rigid legal responsibilities that sit squarely on your shoulders as a business owner. Okay, let's unpack this. Where do we even begin to untangle this web?
Well, I think we begin by drawing a very firm line in the sand regarding who actually does what.
Okay.
Because this is the core division of labor that dictates, literally everything we are about to discuss today. You have to understand that Shopify handles the arithmetic and the paperwork, essentially. Exactly, the math. Their system calculates the tax at checkout, it collects it, and it generates the reports. But, and this is crucial, you hold the legal responsibility.
So they're a tool, not a shield.
Exactly. You have to determine if you actually owe tax in a specific state, and you must legally register with that state's government. I like to say the platform is just a measuring instrument, but the state is the ultimate authority.
That makes a lot of sense. So your dashboard is a compass, but the state draws the map.
Yeah, that's a great way to put it.
And before you can, use that compass to collect a single cent from a customer, you have to figure out where you are legally obligated to do so.
Which brings us to a concept that I know haunts a lot of e-commerce operators.
Nexus.
Nexus, yeah.
Just hearing the word stresses people out.
Right. So what is it?
Well, in legal terms, nexus simply means a connection.
Okay.
It's the specific connection between your business and a given state that gives that jurisdiction the legal right to force you to collect their sales tax.
Got it.
And what merchants really need to realize is that there are two entirely different doors that lead you into a tax liability. The first one is physical nexus, and the second is economic nexus. Okay, let's start with physical nexus, because looking at our sources, the baseline definition seems pretty obvious. Like, if I have an office in Texas or I have employees operating out of Texas, I owe tax in Texas.
Correct.
But the definition of physical presence stretches way beyond just, a traditional headquarters or a storefront.
Oh, it stretches much further. Primarily because states want to capture revenue from businesses that are utilizing their infrastructure.
Makes sense.
So physical nexus occurs when something of yours is physically residing in the state. And the crucial detail that catches so many growing merchants completely off guard is that many states include fulfillment services and the mere presence of your inventory in their definition.
Okay, wait, let's run a scenario here to make sure the mechanics of this are super clear.
What's it?
Let's say I'm running my business entirely from my kitchen table in Ohio.
Okay.
But to get my products to my West Coast customers faster, I decide to use a 3PL, a third-party logistics provider. If my 3PL decides to just, park a pallet of my inventory in a fulfillment center in Nevada, does that trigger physical nexus in Nevada, even if I personally have never set foot in the state?
In many jurisdictions, yes, it absolutely does.
That is wild.
Yeah. You could have practically zero sales volume in Nevada, but the physical presence of your inventory in a warehouse, even one owned and operated by a totally different company, that triggers physical nexus under that state's specific laws.
Wow.
You basically made a distribution decision purely for shipping speed and logistics. but it comes with a massive immediate tax consequence attached.
It's like a ghost warehouse effect.
Ghost warehouse, yeah.
You don't pay rent there, you don't manage the facility, but because your product is sitting on a shelf in the dark in some building, you are on the hook.
Exactly.
That physical door can open without you even realizing it.
Very easily.
So what about the other door, the economic door?
What's fascinating here is how economic nexus operates completely independently of physical presence. You can have absolutely nothing physical anywhere except the laptop on your desk.
Mm-hmm.
But if you sell enough volume into a specific state, you cross their mandated economic threshold, and boom, you instantly have nexus.
Just based on sales.
Just sales.
Mm-hmm.
The danger, however, is that the formula for economic nexus is not standardized at all.
No.
It wildly differs from state to state.
And the sources highlight how absurd some of these state formulas are.
Oh, they can be ridiculous.
You read one state's rule, you think you understand the game, and then you just apply that logic elsewhere and walk right into a trap.
Yeah.
Like California, for example, they say you have economic nexus if you do $500,000 in sales.
Right, a single metric.
Yeah, just revenue.
Yeah.
But New York says $500,000 in sales and 100 orders. Both halves of that equation have to be true.
And the inclusion of that conjunction, it makes a massive difference in your operational planning.
How so?
Well, think about it. You could sell 2 incredibly expensive, highly specialized pieces of machinery into New York, totaling $600,000.
Okay.
You've passed the revenue mark, sure, but you wouldn't cross the threshold because you only had 2 transactions, not 100.
Oh, I see.
But the real trap, though, the one that perfectly illustrates why merchants get into so much trouble, is comparing Arkansas and Connecticut.
Yes, I was looking at this in the notes because they use the exact same numbers, right? But they fundamentally alter the logic.
Exactly.
Arkansas sets their threshold at $100,000 in sales or 200 orders. But Connecticut is $100,000 in sales and 200 orders.
Let's actually run the math on that trap, because looking at a smaller, like a $40 product, illustrates this perfectly.
Okay.
Imagine you have a really solid month of growth, and you sell 400 of those $40 items into Arkansas and 400 into Connecticut.
Okay, so 400 items at $40 each. That's $16,000 in revenue per state.
Right.
Which is well below the $100,000 revenue mark.
Exactly. The revenue is low.
Right.
But look at the mechanism of the Arkansas law. $100,000 or 200 orders.
Oh, no.
Because you process 400 separate transactions, you blew past the order threshold. You now have economic nexus in Arkansas.
Even though it was only 16 grand.
Yep. You are legally obligated to register and collect tax there.
But because Connecticut's law requires $100,000 and 200 orders, hitting the order count doesn't matter, right? Because you missed the revenue requirement by like $84,000.
Exactly. You are perfectly clear in Connecticut.
That is crazy. You generated the exact same sales footprint in both states, but your legal obligations couldn't be more different.
Completely different.
If an operator just models their compliance costs by assuming, like, oh, the threshold is 100 grand everywhere, they're going to face crippling penalties in states like Arkansas.
Which is exactly why relying on generalized summaries or just, assumptions is a fast path to an audit. The specific state law creates the obligation.
Okay, but with 50 states operating 50 different formulas, managing this manually sounds literally impossible.
It's a nightmare manually.
Right. So how does a merchant actually track this day to day? Like, does Shopify handle this monitoring for you?
Shopify does provide tracking, yeah. But you have to really understand the architecture of their system to recognize its blind spots.
Okay, what do you mean?
Well, for store selling in the U.S., Shopify Tax features this liability insights page. It constantly takes your sales data and runs it against all these various state thresholds we just talked about. And the most valuable aspect of this, honestly, is the early warning system.
Yes, the monitoring status. The source material notes that Shopify flags a state as monitoring when your sales hit 80% of its economic threshold in a jurisdiction where you have no physical location.
Right.
And I just think that 80% buffer is brilliant.
It's super helpful.
Because it means you aren't finding out you crossed a legal threshold like 3 months after the fact. You actually get a runway to get your paperwork in order before you hit 100%.
Exactly. It shifts your posture from reactive to proactive. And then when you do eventually cross the line, the dashboard status changes to action required.
Okay.
But, and this is a big but, we need to be very careful with how we interpret that. Because action required does not mean Shopify is officially declaring you legally liable. It simply means a potential liability has been identified based strictly on the data Shopify is actually able to see.
Ah, let's dig into that limitation. Based on the data Shopify can see, what is the system actually blind to?
Well, Shopify's insights are constrained by the data piped into your admin.
Right.
So the system only sees orders placed directly within Shopify itself and outside orders that have been imported into Shopify with valid shipping addresses.
Okay, so if I'm running a parallel wholesale operation
Through an entirely different B2B platform, yeah.
or taking phone orders that I just don't log into the system.
Exactly. Those sales literally don't exist to the Insights page.
Wow, so if I'm doing heavy volume in Texas through an unintegrated secondary channel, Shopify's dashboard might cheerfully tell me, hey, you're only at 50% of the Texas threshold.
Meanwhile,
Meanwhile, my combined business operations actually crossed it months ago.
exactly, you have to aggregate your own data. And furthermore, the dashboard is programmed to track states that actually have state-level economic nexus laws.
Are there states that don't?
Yeah, states without a statewide sales tax, such as Delaware or Montana, they simply won't populate on that dashboard at all.
Oh, interesting.
However, you might still have localized municipal tax obligations in those areas.
Right.
So you really must treat the dashboard as a highly useful indicator, not a definitive legal judgment of your entire business footprint.
Here's where it gets really interesting, though, because human instinct usually kicks in at the exact wrong moment with this stuff.
Oh, absolutely.
Let's say the dashboard flips to action required for a state.
Okay.
I do my due diligence, I check the state's official website, and I confirm that yes, my total sales volume means I definitely have economic nexus. I see that I owe tax, and right there in the Shopify settings is a switch that says collect tax.
I know where you're going with this.
Right. The immediate instinct is to just flip that switch right now. Stop the bleeding, start collecting the tax money from customers to cover my liability, and then, figure out the slow government registration paperwork over the next few weeks.
That instinct is totally understandable, but acting on it is arguably the most disastrous mistake a merchant can make in this entire compliance process.
But the logic seems sound. I mean, I'm trying to be compliant. If I don't start collecting it now, I'll have to pay that tax out of my own pocket later when the state comes knocking.
I get that, but let's look at the mechanics of what you are actually doing if you flip that switch prematurely.
Okay.
If you turn on tax collection before you are officially registered with the state, you are charging your buyers extra money under the guise of a state mandate, but you don't actually hold a legal permit to collect those funds on behalf of that government.
Oh.
You are extracting money from consumers under a registration number that does not exist.
That sounds uncomfortably close to consumer fraud.
Because it is.
Yeah.
It's a massive compliance violation.
Yeah.
You are essentially acting as an unlicensed tax agent.
Wow. Okay, so how do we avoid that?
There is a mandatory 4-step sequence, and the order is entirely non-negotiable.
All right, what are the steps?
Step 1, verify the state's specific rules. Step 2, officially register your business with the state's tax authority and wait for them to process it and issue your permit.
Wait for the permit. Okay.
Yes. Step 3, take that specific tax ID number they give you and enter it into your Shopify admin.
Right.
And only then do you proceed to step 4, which is turning on the tax collection switch.
Register, then collect.
Always.
The golden rule of sequence. The paperwork must precede the transaction.
Exactly.
Okay, so let's assume we've followed the rules, we've registered properly, entered our ID, and Shopify is now dynamically calculating and collecting the tax at checkout. What is this automated calculation machinery actually costing the business?
Well, to understand the costs, we first have to clarify the service tiers.
Yeah.
The engine driving this is called Shopify Tax, and it's actually available across all subscription plans. There's a persistent rumor out there that automated tax calculation is locked behind the more expensive advanced plans, but it's standard now.
Really?
Yeah, the old basic tax feature is no longer an option for U.S. stores.
That's good to know. And the pricing structure they've implemented is pretty fascinating. According to the sources, the service is completely free up to a certain point.
Yeah.
You pay absolutely nothing for the calculations until your store hits $100,000 in global sales.
That's right.
But, and this is huge, how they measure that $100,000 threshold fundamentally shifts your operating expenses depending on when you launched your business.
It's a critical detail embedded in the fine print.
Yeah.
And it drastically alters financial modeling for growing brands.
Okay, so if your store was created before May 13th, 2026, that $100,000 threshold is an annual measurement, right?
Correct. It resets every single year. You get $100,000 of free calculation runway annually.
But if your store was created on or after May 13, 2026, it is a lifetime threshold.
Yep. Lifetime limit.
So once you cross $100,000 in total historical sales, you are paying the calculation fee forever.
Forever.
That's wild. Two merchants could be operating identical businesses doing the exact same volume and have completely different profit margins purely based on, like, launching a few days apart in May 2026.
It does create a distinct structural advantage for older stores, for sure.
So what happens after you pass it?
Once a newer store passes that lifetime $100 K mark, the fee applies to all applicable U.S. orders where tax is collected. The standard rate is 0.35% per order, and it's capped at 99 cents.
Okay.
For merchants on Shopify Plus, the rate drops to 0.25%, also capped at 99 cents.
That cap seems important.
Oh, that cap is crucial for high-ticket sellers. Whether you sell a $300 item or a $3,000 item, the calculation fee never exceeds 99 cents.
Got it. And for that fee, the system handles the notoriously painful granular exemptions, right, assuming you've configured your product catalog correctly.
Right. Categorization is absolutely vital. You aren't just organizing your website for shoppers. You are mapping your products to a constantly shifting back-end database of state tax codes.
Okay, give me an example of that.
Let's look in New York. They have a specific exemption for clothing and footwear, but the item must be priced under $110.
Okay.
And to make it even more complicated, that exemption only applies in certain local jurisdictions within the state.
Why?
The political and economic reasoning is basically to ease the tax burden on necessary clothing while still taxing luxury items.
Okay, but coding that hyperlocal price-dependent logic manually across a massive inventory would require, like, a full-time engineering team.
It would be a total nightmare.
Wait.
But by assigning the correct standardized clothing category to, say, a t-shirt in your Shopify admin, the system recognizes the New York rule automatically.
Nice.
When a customer in an exempt New York zip code adds that item to their cart, the system checks the price. If it's under $110, it automatically strips the tax out.
That's super clean.
And when New York inevitably tweaks that legislation next year, Shopify updates the logic centrally without you having to rewrite your settings.
That is super helpful. One vital carve-out worth mentioning, though, involves digital products.
Yeah.
Things like ebooks, online courses, or downloadable software. You can't rely on the standardized categories to handle those, right?
Not at all. Digital taxation is an entirely different landscape depending on the state.
Right. So for those items, you actually have to go into the individual product settings, manually disable the physical product toggle, and uncheck the box that says charge tax on this product.
Exactly.
Because the system needs explicit instruction that nothing physical is changing hands.
Right. Categorization handles the physical nuances, but digital goods require that explicit manual flag to ensure the system doesn't accidentally apply a physical tax rate to a digital download.
So, okay, we've got the system humming, it's calculating the tax, handling the exemptions, and pulling the cash from the customer. But sitting on that cash is a massive liability.
A huge liability.
The state wants its money. So how does the actual transfer of funds and paperwork happen? Like, who actually files the returns?
Well, the answer depends entirely on which of the 4 operational routes a specific order takes.
Okay, let's go through them.
Let's start with Route 1, the standard storefront order. A customer visits your custom domain, adds a product to their cart, and checks out using a standard credit card entry. Who is responsible for filing the tax on that revenue?
By default, I am. Shopify does not automatically remit the collected taxes to the government on my behalf just because they calculated it.
That is correct. You, or the CPA you hire, must pull the data from Shopify and manually submit the forms and the funds to the respective states.
Got it.
Now, Route 2 is for merchants who want to offload that labor back onto the platform. This is the automated filing add-on.
And this is where we really have to talk strategy because it isn't free.
No, it's not.
The source notes it costs $75 per generated return or $50 if you are a Shopify Plus merchant. And on the surface, paying $75 every month to every single state where you have Nexus, I mean, that adds up incredibly fast.
It does.
But when you compare that to the hourly rate of a specialized tax accountant who is, manually handling dozens of different clunky state portals, the automation fee often becomes the cheaper operational choice.
It really is a calculated trade-off between software fees and human labor costs. However, Shopify has strict eligibility gates for this feature.
Like what?
Well, for example, if you utilized a different third-party tax app at any point during 2025, your historical data is fragmented.
Ah.
And because of that, you cannot use Shopify's automated filing. Similarly, if any customer has submitted a data erasure request under privacy laws, you are locked out of the feature.
Oh, that's tricky. There's also a significant operational trap hidden in how they bill for this.
Yes.
The fee is charged per generated return, not per successfully submitted return.
This catches so many people.
Right. Let's say Shopify prepares the monthly return for Texas, but it doesn't actually get submitted to the state because, oops, you forgot to finish inputting your Texas registration details into the admin.
Right.
Shopify still charges you the $75 for doing the prep work.
And those fees are strictly non-refundable. So the critical deadline for merchants using automated filing is the 9th of every month.
The 9th.
Yes. If the system generates a return that you realize you don't actually need or you don't want to file through them, you must manually go into the admin and skip that return by the 9th.
Wow.
If you forget, the system finalizes it and bills you. Managing the software requires just as much vigilance as managing the state deadlines.
So what does this all mean for alternative checkouts? Because that brings us to Route 3, and I really need to clarify something here that trips up almost everyone.
Oh, the Shop App versus Shop Pay thing.
Yes. The documentation states that as of January 1st, 2025, the Shop channel automatically collects, remits, and files taxes for orders placed directly in the Shop app or on the Shop website. But a huge percentage of my customers use Shop Pay on my own website to check out faster. Does Shopify file the taxes for those Shop Pay orders?
No, they don't. And we need to draw a very bright line here because conflating the two leads to severe underreporting.
Okay.
There's a fundamental difference between the Shop app and Shop Pay.
Right.
The Shop app is its own distinct marketplace ecosystem. If a consumer discovers your brand inside the Shop app and completes the purchase entirely within that environment, Shopify acts as the marketplace facilitator, and they handle the tax filing.
Okay, that makes sense.
But Shop Pay is simply an accelerated digital wallet. If a buyer is navigating your independent website and clicks the purple Shop Pay button just to skip typing in their shipping address, that remains a standard storefront order.
Ah.
You retain full responsibility for filing the tax on that transaction.
So the wallet just changes the friction of the checkout, not the legal liability.
Exactly.
If it happens on my domain, it's my responsibility, regardless of the button they click.
Precisely. Which naturally leads us to Route 4. Outside marketplaces, we are talking about platforms like Amazon, eBay, or Meta.
Right, and the documentation points out a major recent shift here. Meta actually ceased acting as a marketplace facilitator for new orders on August 26, 2025.
Yep, they threw the responsibility back over the fence.
So for Meta orders, merchants now have to file. But for massive channels like Amazon, Amazon still generally handles collecting and remitting the tax for the sales made on their platform.
They do, yes. But if we connect this to the bigger picture, though, this is exactly where merchants get blindsided by economic nexus all over again.
Wait, how?
Well, yes, Amazon is filing the taxes for those specific Amazon sales, removing that immediate burden. But those transactions still fundamentally matter to your underlying Shopify business.
Oh, because of the thresholds.
Exactly. When a state calculates your total sales volume to determine if you've crossed their economic nexus threshold, many states combine your marketplace sales with your independent storefront sales.
Oh, that is a brutal realization.
Yeah, it hurts.
Because I might have very low sales on my own Shopify site in a state like Arkansas, well below the threshold. I have zero liability there natively.
Right.
But because my Amazon storefront absolutely crushed it and sold $100,000 worth of goods into Arkansas, the state looks at my aggregated volume.
Yep.
They declare I've crossed the economic nexus threshold, and now I suddenly have to register and collect tax for the handful of sales I make on my own website in that state.
Exactly. The volume generated on platforms that handle their own taxes can still legally force you to register your independent storefront. You have to monitor your comprehensive footprint across every single channel, not just what happens inside Shopify.
All right, assuming I am handling the filings myself or, packaging the data for my accountant, what actual paperwork am I pulling from Shopify? If you're not paying the $75 automated fee, I need the raw data.
So Shopify actually provides 3 primary reports for this.
Okay, what are they?
Well, at the macro level, you've got the United States Sales Tax Report. That's, your broad summary of liabilities.
Right.
But the true workhorse for compliance is the jurisdiction report.
I really want to highlight the jurisdiction report for anyone listening who handles their own bookkeeping.
It's vital.
Because when it is the end of the month and you need to file a state return, you don't just hand the state a single lump sum number.
Oh, they wish.
Right. States demand to know exactly how much tax was collected for specific counties, cities, and even special tax districts. The jurisdiction report aggregates your Shopify data into the exact hyperlocal shape that a state tax return requires.
Exactly. It translates your sales data into the government's preferred formatting. And if you ever find yourself facing an audit, or, if you just need to investigate a weird discrepancy where a customer claims they were overcharged,
Yeah, that
you
happens.
turn to the third option, which is the detailed transactions report. That gives you the granular line item data for every single tax calculation on every individual order.
We have covered a massive amount of technical ground today.
We really have.
To synthesize all of this, the dashboard is a compass, but the state draws the map. Use Shopify's 80% monitoring tool as an early warning system to get your operations in order. Map your product categories meticulously so the system can handle the hyperlocal exemptions. And above all else, secure your legal state registrations before you ever flip a switch to collect consumer funds.
Never put the cart before the horse. Know where your inventory is housed, track your aggregated volume across all channels, and establish your legal standing before you collect a dime.
Absolutely.
But, this raises an important question, something we really have to ponder as we look at the trajectory of e-commerce.
What's that?
States are aggressively refining these fragmented economic thresholds. Furthermore, we are seeing local municipalities require their own distinct taxes. Even in states with no statewide tax, like Alaska, you still have to navigate local municipal codes. We are currently trying to patch an analog, geography-based tax system onto a borderless digital economy.
And the friction is only going to increase as businesses scale faster and borders mean less.
Exactly. So the provocation for the future is this. Will the sheer unmanageable complexity of 50 different rulebooks eventually force the adoption of a unified federal digital tax standard?
That would be nice.
Or are we inevitably hurtling toward a reality where AI is legally required to instantly calculate, split, and remit fractional tax payments to thousands of different local, town, and city jurisdictions the exact millisecond a customer hits buy?
Wow.
Something has to give, and how that tension resolves will really define the next decade of commerce.
It's a massive structural question, but for now, for you, the listener, the next time you're shipping orders across the country and that 3:00 a.m. cold sweat hits, you don't have to panic.
No panic needed.
You just need to check your 80% warning, figure out where your 3PL parked your ghost inventory, and remember to register before you collect. You've got the tools to handle this. Until next time.